But the thing that's interesting is that these, with the system under strain, I guess this is why people like Jamie Dimon are saying gold's going higher, and why, Morgan Stanley sort of turn around and say you should, put 20% of your portfolio into gold. Now, that's an extreme statement. A very extreme statement. But I think that the really senior bankers see these dangers. They must be concerned about it. And I think that they would have told the Fed, look, you can't go on tightening like this. We're losing deposits which are going into the general account, and we're not seeing it come out the other side. We are under strain. You carry on this way, you're going to see the same sort of thing we had in September 2019. You may remember when the repo rate suddenly shot up to about 9%, and the Fed had to come in and sort it out. But we're not far from that sort of thing happening. I mean, it is tight, very, very tight. But where does this take us? Well, the thing that's absolutely clear is that if we can look through the top of the credit bubble, when it starts going down, Danny, you will see inevitably the duty, if you like, of the Fed and the US government basically is to keep the show on the road. And how did they do it? They would just accelerate the printing presses. What did they do in Germany in 1922? Accelerated the printing presses. We have exactly the same situation. And on top of that, we can superimpose our lessons from 1929 to 1932. The difference is that in those days, businesses went bust because the dollar was on a gold standard. And the only way in which credit got wiped out was by debtors going bankrupt. And the debtors included something like 10,000 banks. They went bust and didn't honor their deposits. Today, of course, you don't have that. So where is the strain? What happens? How do you reduce the amount of outstanding credit? Well, you don't reduce the amount of outstanding credit, but what you do is you reduce its value. Its value contracts, collapses even. And that's the way in which this is going to work. And the value of credit collapsing starts with the currencies. Currencies will go down. And unless the political class actually wake up to this, and unless their advisors get off all this macroeconomic rubbish and actually begin to apply proper classical economic lessons and inform the politicians of that reality, then there is no way that the fall in the purchasing power of these currencies is going to stop. That's what's required. We've got to go back onto a gold standard. In effect, do you see that? No, I don't see that. And I certainly don't think that 8,130 tons allegedly in the coffers of the US Treasury are there. I don't think they're there. I think there's a big shortfall. So you've got a credibility problem, which is being well aired, and it's well aired even by people like Scott Bessent. Guess what? As soon as he becomes Treasury Secretary and he gets his feet under the desk in the Treasury Department, what happens? He is told, don't say anything about gold. Stumm, don't talk about it. Why? Well, I can see two reasons why. Firstly, they are in denial about gold because they have been promoting the dollar as gold's substitute, if you like. It's a dollar standard around the world. The second thing is a lot of that gold, I think, went out. It was leased and never came back. You open Fort Knox, I think someone rather cleverly said, you find a whole bunch of IOUs sitting there. We don't know whether this is really true because, of course, we can only surmise. But intellectually and practically, I think it's going to be extremely difficult for the mighty dollar to if you like, get away from its total collapse. So that's what we face. I mean, this is a very serious time. We are in a sort of, if you like, an intermediate stage where, the Fed is trying to put some liquidity back into the system because it sees the danger. It's been told the danger by its intelligence in the commercial banking network. That will give us a little bit of relief. It might even puff equities even higher. I don't know. But the only way you can get out of this, basically, is get the hell out of credit. It's really dangerous now. Get out of credit, which means getting into real money, which is metallic money with no counterparty, and it is final settlement for all credit, and that is gold. Well, it's impossible to say how long the final collapse of the dollar will happen. And you never know, I may be wrong. You could find that the authorities turn around and actually do something sensible like secure the value of the dollar somehow. I mean, there may be some sort of fiddle they can do and all the rest of it. I mean, people have been talking about a reset for ages. It's not a reset. It's just to try and secure the value of the dollar. The only way that can be done ultimately is basically by going on to a gold standard. this slide, I think, could happen quite quickly. I mean, once the credit bubble bursts, I've got people who sort of, seem to have been very successful in terms of, reading cycles and things like that. And I think we're looking at March next year, ultimately. But I wouldn't be surprised if it happens before then. When that happens, basically, you should already be completely out of credit, because the collapse, I think, will be really quite rapid from that point. And they will obviously try and do what they can to stop it and all the rest of it, but it's just going to undermine the purchasing power of the dollar. So in terms of time, I don't think we're far away from the end of the fiat currency system. And the point about being close to the end of the fiat currency system is that we're close to it. Fiat currencies not being there. Now, either they're replaced by something else like a new gold-backed currency or whatever, or they tie it to gold, and incidentally have to take the economic actions to ensure that it sticks. We're nowhere near that. I don't know. I just sort of feel that we are actually moving more rapidly than we think towards the end game of fiat currency.
Every fiat currency system in history has ended the same way, crushed under the weight of its own debt. It always starts quietly, wrapped in optimism, and ends in denial, with policymakers insisting that printing money can somehow replace real productivity. The United States, like every empire before it, has reached that stage. The cracks are visible, and the numbers no longer add up. The U.S. Treasury is now effectively funding itself through short-term T-bills, a polite way of saying IOUs, not because it wants to, but because it has no choice. The long end of the bond market is dead. There's little real demand for 10-year or 30-year bonds anymore, because investors no longer trust they'll be repaid in dollars that still hold value. So Washington has turned to the short end, constantly rolling over debt, robbing tomorrow to pay for today. That's not fiscal management, it's desperation. When a government relies on short-term debt for survival, it's like managing a mortgage that needs refinancing every 30 days at floating rates. The second confidence falters, the entire system collapses. In effect, the Treasury is printing money through the back door. T-bills are near cash instruments. When the government issues hundreds of billions of them to fund spending, it's flooding the system with liquidity, even if officials pretend otherwise. On paper, it's all denominated in Federal Reserve dollars, but functionally it's no different from printing new money. Here's where it gets dangerous. When the Treasury delays spending, during partial shutdowns or political standoffs, that cash doesn't circulate. It piles up in the Treasury's general account, draining liquidity from the private banking system. The result is volatility in credit conditions. One week the system is bone dry, the next it's overflowing. Add quantitative tightening, QT, to the mix, and you get systemic instability. The Fed's QT program was meant to shrink liquidity, but it's already failed. They've quietly slowed balance sheet reduction, and soon they'll have to reverse course entirely. Quantitative easing, QE, will return because there's no other way to keep the structure standing. This is what I call the credit printing carousel. Every lever the authorities pull leads back to the same place: more credit, more money, more debasement. They can't stop without triggering collapse. The parallels to Germany in the early 1920s are haunting. The Weimar government faced enormous war debts, weak tax revenues, and social unrest. To stay afloat, it issued short-term bills to cover long-term obligations. For a while, the currency held up, until confidence broke. The mark collapsed, inflation exploded, and the middle class was wiped out. We're not there yet, but the pattern is unmistakable. The U.S. is following the same playbook, rolling over unpayable debt, monetizing deficits, and pretending inflation is transitory. It's the largest credit bubble in human history, and the outcome is inevitable. When this bubble bursts, and it will, the Fed and Treasury will step in to rescue the system. Subscribe, share, and join our community of thinkers who see beyond headlines into the truth that's shaping tomorrow.